Some trends are so influential they can move entire sectors of the market. Take demographics. Our aging population could impact the performance of all healthcare companies, but selecting precisely which companies will benefit can be challenging. The Healthcare Sector Spider ETF offers the diversification of the entire healthcare sector while minimizing your single stock exposure. The Healthcare Sector Spider, the next chapter in investing. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
All right, coming up on today's show, how to make profitable decisions when stocks are falling. We're going to talk about that on today's program. Also coming up, we're going to get into what's going on our Twitter feed. A lot of good stuff there, as well as a recap of what's going on in global financial markets, as well as industry sectors and all the ETFs tracking them. If you'd like to join us, 844-305-7800 is the number. Give us your first name along with your city and any ticker symbols you want to talk about, stocks, ETFs, mutual funds, we can do that. Again, 844-305-7800. You can also tweet us live at Index Show is my Twitter handle, and we're there, of course, 24/7. So taking a look at market action this past week, it is October, and we saw a continuation of the decline in U.S. stocks. My goodness, what a month it's been. And just for perspective, just to give you an idea of how rough it's been for equity investors, we've got the S&P 500 down around 9% on the month of October, which would make this the worst month since February of 2009 and the worst October since 2008 if it finishes the month at its current level. So that's some historical perspective just to help you understand how difficult a month it's been for equity investors. Now, of course, nobody remembers history, so that's why we need to give you some historical perspective. But the point here is we've gone from an extreme of overly bullishness, right? That's how the market's been for most of the year. One all-time high after the next. And now, here we are in October doing the exact opposite. One all-time monthly low after the next. So, you might say then 2018 is really become a year of extremes. Extremes to the upside, extremes as we're seeing on October to the downside. Will we be able to find a middle ground? That's what we're watching for. We've seen a little bit of a bounce. It was abbreviated earlier this week, but we just got to get out of October. That's my view on it. October is a bedeviled month, historically speaking. Once we can get out of October, hopefully not too badly scathed, I think the market will find a happy medium. Because when we take a look at corporate earnings have been mixed, but the vast majority of companies have still beaten earnings per share estimates by analysts. FactSet keeps track of this data, and around 80% of S&P 500 companies, again, have beaten third quarter earnings expectations from analysts. Now, we've had some pretty high-profile misses. Amazon.com missed, Google missed, and at the opposite spectrum, we've had high-profile hits or excess expectations, for example, in Microsoft and Netflix, which both blew out earnings to the upside. And so it's been a mixed bag for certain companies. But overall, if we take a look at just the broader S&P 500, still we've got pretty good earnings with 80% of those companies outperforming or beating expectations. So that's good. And we also have, of course, a historically bullish seasonal period ahead of us. November and December historically have been bullish for stocks. And so will this year be different? Will this year be unlike most Novembers and Decembers? Well, we're going to see. We're going to find out very quickly. My leaning tends to be that we will see a rebound. We will see at least a short-term, the bull short-term return, at least for November and December. So this is going to present some very interesting trading opportunities. We're going to talk about this on today's show, how to make profitable decisions when stocks are falling. We're going to talk about a classification or categorization of ETFs known as inverse or short ETFs. These are funds that are designed to go up in value when stocks are falling. And we've had some excellent performance for inverse performing ETFs in the month of October. And I'm going to give you some ticker symbols on today's show, funds that you can take a look at least start tracking, and perhaps take a look at for incorporating into the strategic portion of your investment portfolio. The context for this, as most listeners know, the correct context is your non-core portfolio. That's what I teach on this show. That will help you to bring your investments in harmony and have a congruent and architecturally sound approach as you push forth and push forward towards your retirement investment goals. 844-305-7800. That is the number. This is a live program. We're here. How have you been doing in the month of October? We've talked about it over and over again, the importance of having an adequate cushion or margin of safety inside your portfolio. I think that's one of the defining aspects of this program that's very different than other financial programs that you may hear or listen to or watch, is they don't teach this. They don't teach you to have an adequate cushion inside your portfolio. I have a margin of safety worksheet which will help you understand exactly how much of your portfolio should be committed to a cushion or safety. We talked about this also on last week's show. If you missed it, it's available via podcast. You can go to indexshow.com. You can also go to iTunes and search under the Index Investing Show, and you'll find it there. But we discussed this to help you understand how much of your portfolio should be earmarked for safety. Also, my online classes, I provide this margin of safety worksheet. It's a one-pager that will help you do some simple calculations and arrive at the right number or percentage of your total portfolio that can help you to sleep well at night and make sure that you've got an adequate cushion regardless of whether market conditions are good or bad. Because that cushion, it's just like insurance, right? Whether it's hailing or whether the sun is shining, you always have insurance, right? We insure our homes, we insure our cars, we insure our lives, we insure our health, right? So why wouldn't we insure, or why wouldn't we protect our investments? Well, we should be doing that, but unfortunately many people are not. They're fully invested. They've been taught the wrong way. They've been taught to just, suffer and wait it out. See, that's old school, antiquated thinking. It's outdated, and it's certainly not a prudent approach, especially when the fury of a bear market comes. And by the way, this is not a bear market as of yet. What we've seen in October is not a bear market by any measure. It's a market correction, but it's far from a bear market. So if you're having trouble with what's happened in October and it's really shaking you, well, you ain't seen nothing yet, because we are way overdue for a bear market. It will happen. It's guaranteed. You're not supposed to say that anything's guaranteed when it comes to money and investing and finances, but I will guarantee that we are going to have another bear market. What I can't guarantee is when that will happen. We don't know that exactly, but the point is we want to be ready. It doesn't matter when it's going to happen. The point is are we going to be ready for that moment? Are we going to be able to endure that moment? Are we going to be able to have the stamina, the patience, and are we going to be able to also look at opportunities to make money from that? So we're going to discuss this on today's show. Get you ready for even more downside action. We know it's going to happen at some point in the future. But in the meantime, we're here if you'd like to join us, 844-305-7800. How are you doing? Call the program, let us know. At Index Show is my Twitter handle. I'll be right back.
The Index Investing Show with Ron DeLegge.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
Well, one of the things that gets me highly interested in this market decline, and also, I guess, puts doubts in my mind about whether this really is the beginning of a new bear market. I think it's quite premature to refer to this as a bear market, because up till now, all it's been is a market correction in stocks. If we take a look at the bigger picture, and that's what many people, unfortunately, don't do when they're panicked, when they have a certain bias that is towards one school of thought or the other. But if we take a look at the bigger picture of what's going on in global markets, just for example, the total U.S. stock market is now up by just 0.25% this year. Ticker symbol SCHB is the ETF that tracks the total U.S. stock market, large, mid, and small company stocks. Now, you recall this particular ETF was up around 10% before October started. We've lost almost all of those gains, but we still are in positive territory nevertheless. If we take a look at international stocks, for most of the year they have been in negative territory, and they continue to be that way. VEA, which follows international stocks in developed countries from around the world like Japan and the United Kingdom and Australia, down about 11.5%. Emerging market stocks have been laggards all year long. VWO down almost 17%. We have seen a rebound in some of those emerging market countries like Brazil, which have made a strong comeback, and that's certainly a positive sign. But some of the bigger emerging market countries, the mega countries like China and India, continue to trend down. Taking a look at commodities, another major asset class, down about 1.5%, USCI. And then total U.S. bond market down just a nudge over 2%, ticker symbol BND. And then going back to my point earlier of why I think that this particular market is suspect in terms of being a brand new bear market is take a look at the price of gold, which is considered a defensive asset, a hedge against the unknown. Ticker symbol GLD, which tracks the price of gold bullion, is down year to date 5.5%. Now, granted, it has popped higher here in October. It's gone up, but on a year-to-date basis, it's down. And so gold is still in a funk, and you would think in a market climate that is negative, in a market climate that is bearish, you would think that gold would have better performance, but it hasn't. Now, granted, like I said, for the month of October, gold has posted strong returns. Gold is up about that same amount, 5.5%. But still, bigger picture, year-to-date, gold is negative. So that's your global perspective on the major asset classes. 844-305-7800 is the number if you'd like to join us. How are your investments doing in October? Pose that question to you. What changes do you plan to make? What changes have you made? 844-305-7800. At Index shows my Twitter handle. Coming up in the next segment, Dan Dolan with the Select Sector Spider ETFs will be joining us. We're going to give you an update on what the performance has been industry sector-wise, taking a look at the S&P 500, seeing what's going on underneath the hood. So stay tuned for that. Dan will be coming up on the program. I want to discuss with you now some of the things that you need to know about how to make profitable decisions when stocks are falling. And one of the tools that we have at our disposal that we didn't used to have before are ETFs that are designed to increase in value when market prices fall. Now, for most of the year, stock prices have risen. So the year-to-date performance of inverse or short ETFs linked to equities has not been good. But the month of October, we've seen a sharp decline in the value, in the price of stocks, particularly in the U.S., and that's been a real boon to some of these inverse performing ETFs. Take, for example, SPDN, and this is one that you can put on your radar screen. SPDN, which goes 100% daily opposite of the S&P 500. So SPDN over the past month, just to help you understand how it performs, has gone up 9% in value. Meanwhile, the S&P 500 ETF, SPY, has declined by that same amount approximately. So SPDN aims for 100% daily opposite exposure. So that means on any given day, if the S&P 500 goes down, let's say 1%, SPDN by design should be up by 1%. That's its goal. That's what it does. And it's a great way to look at hedging your investment portfolio against the potential for the future declines. It's also a way to avoid the trouble of having to go out and figure out, well, should I short specific stocks to make money in this kind of market? Well, you can, but that's very risky. You got to borrow money from your broker. If that stock's not available for borrowing, then it can become very, very tricky and very complicated and beyond the knowledge of most individual investors. Shorting is a exercise that usually is earmarked for the professional investor. But for the retail investor, for the individual investor, this means then to take a look at other tools that are at your disposal. And I think inverse performing ETFs are a excellent tool to help you to easily capitalize or profit when stocks are falling. And SPDN is a perfect example of that. That ETF is called the Direction Daily S&P 500 Bear 1X shares. And again, that's 100% daily opposite exposure to the S&P 500. So that's just one simple example of an inverse ETF that I think you can put on your radar. And it's also one that I think is good because it does not use any sort of leverage. In other words, it does not try to magnify its performance. And in this kind of market, I don't think you really want to, at least in the U.S. stock market, I don't think you want to use those leveraged short or leveraged inverse ETFs just yet, because I think it's too early at this particular stage to really see a long trend that the trend is really not a short-term trend but a longer-term trend. I think those leveraged ETFs will do better when the downside in stocks is more protracted and more confirmed than it is right now. Right now, it's just a market correction, and I think the leveraged ETFs are best used in other markets where there is a little bit more of a downtrend that's established. And I'm going to give you what some of those markets are in the fourth segment of today's show. I'm going to give you some ticker symbols of areas where I think on the bearish side, where I think you can use those leveraged inverse performing ETFs and have some success. But for now, SPDN is one to keep on your radar screen. Again, that ETF aims for 100% daily opposite exposure to the S&P 500. It's been a great performer in the month of October and over the past month. And if stock prices continue to fall, it will continue to do just what it's designed to do, increase in value. 844-305-7800 is the number. This is the Index Investing Show. Coming up next, Dan Dolan with the Select Sector Spider ETFs. We're going to give you a recap and update on sector investing strategies. Be here or be nowhere.
The Index Investing Show with Ron DeLegge.
The investment world is full of complex and expensive products. At Sector Spiders, we recognize the need for lower costs, more clarity, and greater focus. So we wrote a new chapter for today's investors. Sector Spider ETFs divide the S&P 500 into 10 distinct sectors. You can see exactly what you're investing in with full transparency. Each sector has the diversification of a mutual fund, the flexibility to tailor your investment strategy, the all-day tradability of a stock, and the tracking of an index. Sector Spider ETFs can be used to customize your portfolio allocations, overweight or underweight your sector exposure, and minimize single stock risk. Now it's time to turn the page to a clearer, more focused approach. Sector Spider ETFs, the next chapter in investing. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for a prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
So how bad has the stock market been this October? Well, for some historical perspective, we're having the worst October since 2008 if the S&P 500 finishes at its current level. Here to talk with us about that much more is Dan Dolan. He's Director of Wealth Management Strategies at the Select Sector Spider ETFs. Go to sectorspider.com. You can also download the Sector Spider app. It's now available at Apple's App Store. Dan, welcome to the program. Great to have you back.
Thank you, Ron. Always a pleasure.
Up until October, nearly everything in the stock market, as you know, was great. But since the start of the month, year-to-date gains in major indexes like the S&P 500 and NASDAQ have been wiped out. And 2008 really is turning out to be a year of extremes. Before October, we have overly bullish sentiment. Now we have just the opposite, overly bearish sentiment. So what's been driving stock prices in October?
Well, I think there's a few things, and some of it's noise, and it's noise everything from politics and trade, and upcoming election and things like that. That'll work itself out. The second is the Fed, which is a real issue. So the Fed has raised rates 3 times, probably one more time in 2018, and then the question is, what do they do in 19? I don't think the Fed, is a real problem. It's the unexpected that truly hurts us in the stock market. This has all been well out there. They're doing as they said they're going to do. So I think we'll get ourselves through the Fed. The third issue, which is a real issue, is earnings. And as you look at the earnings and the companies reporting, they continue to be pretty good. Even some numbers this week with Amazon and Google and alike, people say they're not good enough. Well, you try growing your numbers like they are at 20% plus off the revenue base that they're doing. So I think when it all settles down, the numbers will be what drives it, and the numbers continue to be pretty good. And particularly when you look at the equity markets or fixed income, at what point will a 3% Treasury for 10 years look good when you can invest in a high basket of quality of U.S. equities or something like that? So I think it's going to settle, and as earnings continue to do okay, we'll be just fine.
Now, from an industry sector perspective, the recent sell-off has not been bad for all sectors. In fact, it's been quite good for some of those defensive sectors like consumer staples, ticker symbol XLP, and utilities, ticker symbol XLU. On a relative strength basis, both of these groups have held up better versus the broader S&P 500. What's going on there?
Well, it's your classic, cyclical growth type stocks versus defensive income orientated stocks. So what you're seeing here is that there's a flight to quality, that you're moving to kind of the lower PE, higher dividend type of sectors, and utilities and staples and REITs doing pretty well. So even, we talked about the Fed moving 3 times this year already, expected to do more. Utilities are up on the year. Utilities are up 3 or 4% on the year. So, people are going for that quality. They're going for the stable type of sectors that pay decent income, and I think that's probably a good place to be.
And the thing about utilities, too, they've been making that run with higher rates. Typically you would think that they would do the opposite. They would go down with rates going up. But that just shows you, like you said, to your point, that investors view them as a defensive hedge. Again, if you're just joining us, we're talking with Dan Dolan at the Select Sector Spider ETFs. Go to sectorspider.com. You can also download the Sector Spider app at the Apple App Store. In the last 40 years, around 70% of the market's return came from dividends. That would mean a reassertion about the important role dividends play in a person's investment strategy. So what are the things that we should keep in mind when it comes to dividend investing as it pertains to industry sectors?
I agree with, a large portion of the return, the total return is in the dividends and will continue to be that way. One thing I would caution on the dividends is that sometimes when we look at dividend-paying companies, we get overweighted in certain sectors. So, historically we mentioned utilities, we mentioned REITs, that those are, two sectors that people go to the most. I like it, just don't get too overweighted there. Think of things like staples that could be paying 3 or 4%. Telecom stocks like AT&T and Verizon are 4 or 5, 6%, some of those stocks. So don't put all your eggs in one sector when you're thinking dividends. Spread that risk around a little bit. Dividends are an important part of total return, but spread the risk.
Now, most stock pickers do worse versus the broader stock market indexes. They also, by the way, do worse versus their peer industry groups or sectors. And as 2018 nears its end, this may present an opportunity to do some tax loss selling. Now, one of the most perfect candidates that I can think of to do this with would be General Electric. So using GE as an example, how could an investor employ a tax loss harvesting strategy?
Yeah, you make a real good point. This year is the first year in a while that you have a market which will give you some gains, it'll give you some losses. So as you move into November and December, you should be realizing some of those losses offset some gains. Something like GE, and the beauty of an exchange-traded fund, Sector Spider being an ETF, you know exactly what they own. So what we know about the industrial Sector Spider is that it's about 5% General Electric. So if you own GE, it's also 5% of XLI. GE's down about a third this year, so it's down over 30%. You may have gains in another part of your portfolio. Take your loss in GE. If you want to maintain exposure to GE, you could sell GE, buy XLI, you buy GE and 50 other stocks or so that are in that basket, hold it for 30 days if you like, and then after 30 days you can reestablish your GE position or continue to hold a more diversified basket of industrial companies. So after 30 days, you don't have to worry about the wash sale, and you can realize that loss. So again, the nice thing about ETFs is that the holdings are disclosed every day, and the weightings are disclosed every day. So stocks like DuPont, as another example, that it's a very widely held company. DuPont's down 25% this year. It's the largest component of XLB, the material spider. So it's 20% of XLB. You could sell that, realize your loss, still basically own 20% of DuPont, and realize a loss, no wash sale exposure. So know what you own, take a look what's inside these baskets, and you can make some really smart tax trades.
One last thing before you take off, the Sector Spiders now have their very own mobile app. It's now available at iTunes. We encourage everybody to download it. I've been using it. It's great. One of the things I like about it, instead of getting ticker quotes on one sector ETF at a time, you can just download the app, open it up, and get simultaneous quotes on all 11 sector ETFs by just, again, opening it up. What are some of the other features, though, about the app that you like?
Well, just to add to it, and thanks for mentioning it, well, also the Google side of this is coming before the end of this month, too. So within the next week or so, they'll be available on the Android and other products like that. So what we try to do is give you a quick snapshot, right? So you go to the home page of the app, and you know the S&P is plus or minus 1 or down 2%, whatever it may be. But on the home page, it sorts by which sector is performing best to worst and intraday. So you know what the market's doing, what's under the surface, what's up, what's down, and then you can dig deeper into any particular sector that you like. the components that make that up, and what type of performance they're contributing to that. So in one quick view, we give you the market, but then underneath the surface, what's happening.
Yeah, a lot of good stuff there, and we'll be talking more about the app in the coming future, and looking forward to that Android app when that's available. Dan, great interview. Thank you for taking the time. Again, you just heard from Dan Dolan at the Select Sector Spider ETFs. And by way of reminder, if you ever miss our regular radio broadcast, you can always pick up our podcast. It's available at our website, indexshow.com. You can also pick it up at iTunes. Just search under the Index Investing Show. Also on YouTube as well as SoundCloud. 844-305-7800 is the number. We're here if you'd like to join us. What have you been doing with your investment portfolio? Take a look at any losers, stocks that have not done what you want. Maybe you're at a loss. Take a look at doing some tax loss harvesting. I'll be right back. This is the Index Investing Show.
The Index Investing Show with Ron DeLegge.
Have an investing question for Ron? Call 844-305-7800 or send your questions to @IndexShow on Twitter.
So the Select Sector Spider app, the mobile app, is my go-to place for sector investing. I've got it downloaded on my iPad as well as my iPhone, and it's just got a great clean interface. It's easy to use, and it's got all 11 sector ETFs right next to the S&P 500. You can see the performance in one screen, one snapshot. I don't got to go quote by quote, ticker symbol by ticker symbol. I can see a visual snapshot right on my screen all at once. And again, that's available at the App Store, Apple's App Store. I encourage you to download it. The Google Android version will be coming out shortly. We'll keep you posted on when that's available. 844-305-7800 is the number. You're listening to the Index Investing Show. Some things on our Twitter feed that happened and are happening as we speak. There's a bull market in bear market headlines. Yeah, that's the way it usually works with the media. Use days of market strength to strengthen your investment portfolio. That's words of advice on my Twitter feed. Here's a retweet from a fellow by the name of Stockcats. He says, could have sworn I heard someone say we could see a cyclical bear market within a secular bull market. He's probably referring to somebody on Bloomberg or CNBC or one of the four-letter networks. This was probably said, Stockcats, by a responsible smoker who does it only under the safest of circumstances. I put responsible smoking, of course, responsible in quotes. Also, I've got a link to the Pew Research Center. Those of us wondering, are we still in the U.S. middle class? Are we still considered middle class? Well, they've got a nifty income calculator that will tell you if you're a middle class person. And they define it by various income statistics that they've aggregated. And it's a pretty interesting online calculator. Also, lessons in how vision can help you impact in a positive way your bottom line when it comes to retirement planning, and the need to really visualize and think about where you will be in the future. So I've got a link to an article that talks about the importance of picturing what you want to do in retirement. Here's a retweet from a fellow by the name of Jesse Felder. He said, 2 Fed officials remain unfazed by the global rout of stocks that's happening in October. Well, of course they're unfazed. They're bond investors. That's why they're unfazed by the fall in stocks. It's the Fed. They only invest in bonds. They don't care about what's going on in the stock market. Also, I've got a retweet of ETF Guide. The latest fourth quarter guide. It's a commodities guide. It's got a listing of all of the exchange-traded products that track the various commodities, from broad-based commodity indexes to single commodities like wheat and coffee and natural gas and oil. So you can check that out. You can download it. It's free, and it's on my Twitter feed at Index Show. So taking a look at some things that can help you make profitable decisions when stocks are falling. We talked earlier in the program about ticker symbol SPDN, which aims for 100% daily opposite exposure to the S&P 500. It's an ETF that I think is defensive in nature, especially in a market that's falling, and it does not use any leverage. It aims for 100% daily opposite exposure. So if the S&P 500, for example, is down, let's say 1% on any given day, SPDN by design will be up by 1%. That's how it's supposed to work. Now, for markets that are in a free fall, markets that are down, let's say double digits, that are in a confirmed downtrend, these are the type of markets that you should be looking at using if you're going to use leveraged ETFs that go inverse or short these markets. That's the place where I think it's best to use the leveraged ETFs because of the fact that the trend is down and it's sharp. And that's when these types of ETFs tend to perform the best, is when that trend is confirmed and when it is prolongated. And so taking a look at a couple of markets that I think you should be aware of, and we've talked about them many times on the program, but where there is a definitive bear market. So a couple of areas. The first area that jumps out at us is emerging markets. Ticker symbol EDZ, which aims for triple daily opposite performance to emerging market stocks. Now, I told you earlier, emerging markets as a group are down almost 17% since the beginning of the year. Well, take a look at ticker symbol EDZ, which aims for triple daily opposite performance to emerging markets. It's been a great performer over the past, really year to date. It's gone up almost 50%. So EDZ is a good one for you emerging market bears. EDZ is the ticker symbol on that. Another one for developed market bears. Now, these are international stocks, which have also been weak like emerging market stocks, but these are developed stocks or stocks from developed countries like Japan, Canada, United Kingdom. As a group, this has been a weak performing area. It also is down double digits, down about 11.5% year to date. So take a look at ticker symbol DPK. DPK, that's David Paul Kennedy, and it is ahead by just over 36% since the beginning of the year. And so this is another perfect example of an ETF that you should put on your radar. And if you're going to short with leverage and use an ETF to do that, this would, I think, would be the right place to do that. Developed international markets, ticker symbol DPK, David Paul Kennedy. Those are that's the ticker symbol. So, and then one other area I'm going to give you, and this is actually I'm going to give you two other areas. One other area is focused on just one market, and that's China, which has been one of the weakest markets globally. China, of course, is an emerging market country, among the largest in the globe, across the globe, right ahead of India and Brazil. But ticker symbol YANG, Yang, is ahead by just over 23%. And that one aims for triple daily opposite performance of Chinese stocks, Yang. And so that's another one that has done well, leveraged, inverse performing, or short ETF. And then one final one is a bonus to just show you that regardless of the markets where the decline is happening, whether it's stocks or whatever, it doesn't have to be just one asset class. It could be not just stocks, it could be other areas, and a perfect example of that is bonds. Long-term U.S. Treasuries have not been good performers. Long-term U.S. Treasuries as a group, since the start of the year, are negative. They have fallen about 7.5%, which is a pretty big move for the bond market. And you take a look at the ETF that aims for opposite performance to long-term U.S. Treasuries with leverage, TMV, Thomas Mary Victor, TMV, it's ahead by just over 25%. And so there, too, is another example of an ETF that is an inverse performing fund that, again, can help you to make profitable decisions when markets are falling. Whether it be stocks or bonds, you can capitalize on that. You no longer have to sit and watch your account go down or sit by the sidelines and observe. You can be a participant, and hopefully a profitable participant, in taking advantage of these various moves, being tactical, and doing that in the context of your non-core investment portfolio, because that is the correct and only context for this type of trading. Well, that's been it for another episode of the Index Investing Show. Be sure to tune in again next week. We'll be here, same time, same station, talking the birds and the bees of successful investing. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.